Today, a perspective on the US property market. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering property and finance news with an Australian and international flavour. And today I'm joined by a new guest, Anthony Davis. Hello, Anthony.
Hello, Martin. How are you?
Very good. Thank you very much for spending some time with us, and great to have you on the channel. Thanks for reaching out. I think before we get into the details of the US property market, let's just do a little bit of a background on yourself so that people can understand where you're coming from and what you've been involved in. But, you know, in essence, a Brit, having lived in Australia, now living in the US with a considerable set of exposure to property in various aspects. So give us a little bit of background.
Sure. So I left the UK in the mid-90s. I'm British originally, from London. I grew up on the south coast. Went to Australia after working in London for a bit. I went to Sydney, like many Brits do, backpacking. Met my lovely wife in Australia, and then but I also worked for a startup company that was setting up in Sydney called Citrix. I worked for them for many years, covering Asia Pacific for them. And after a while, they asked me to either move to Hong Kong or their global headquarters. That was in 2002. I chose to move to their global headquarters in Florida because it's a lot less expensive than Hong Kong. And so we upped sticks and with my two very young children, and we moved to South Florida. And we moved to South Florida when it was all going strong in the Florida property market. I worked at various technology companies in Florida. After a while, we got our US citizenship. So I carry 3 passports, actually. And then we made a decision in 2012 to move back to Australia for a couple of years, to go back to the house we were living in, actually in Brisbane, and have our kids experience a bit of the Australian life, which they weren't too keen on. So we ended up moving to North Texas, where I live now. I live just between Dallas and Fort Worth on the north side, a city called Southlake. And we chose this area because of the pretty low cost of living, and also the great transport through DFW Airport, great job opportunities, those sorts of things. So schools are great here as well, obviously. So that's me, really. So I lived all over the world. I've lived in 5 countries, citizen of 3. And I have properties all over the world. I've been a constant avid property investor most of my life. Just bought my first property, which I still own, when I was about 19 years old in East London, Old Street, central London, actually. So good area to buy property, by the way. And I've been buying, property progressively over the years in all these different locations. And in general, it's been a good experience. It wasn't such a good experience in Florida, and I can tell you more about that if you like. But it's generally been a very good experience, and been a good investment portfolio generally as well.
Okay. Well, let's touch on the US situation and perhaps touch on Florida, because of course Florida was quite significantly hit through the global financial crisis and beyond, right? So you, I think, were in the middle of that.
It was.
So it might be interesting to hear a little bit about that and what you saw and what you learned.
That's right.
And, I think people perhaps should understand that this wasn't something that sort of happened overnight and then suddenly corrected, right?
That's right.
The outfall of this is probably still playing out in the Florida area, isn't it?
Absolutely is. So yeah, in 2005 we bought our house in South Florida, big house actually, and we hadn't been in the US that long, and we're still on. I don't think we even had our green cards yet, and yet the bankers were very willing to lend us more than $500,000 US. We just after we bought the house in 2005, a very large hurricane came through in South Florida that wasn't very well documented internationally, I don't think, but a hurricane called Hurricane Wilma. If you look that up on Google, you'll see it was a Category 5 hurricane, and it came from the west of Florida too. Unusually, most of the hurricanes come from the east. So the Florida housing market was very hyped. Everybody was telling me that, all these retirees were coming down from Boston and New York and Philadelphia and places like that and moving to South Florida. And actually they are. There's a consistent trickle of people that are coming down to that area. But it was very, very hyped, as in you've got to get into the property market now. There's loads of New York money coming down here, and it's going to buy up everything. And the market was going up at about 10 to 12%. So huge property equity gains there. So we bought in at an inflated price, of course, in 2005, one of the worst times to buy. When you think about it, didn't know that then. And then the hurricane came through, and so not only were in 2006, 2007, not only were our properties declining significantly, but they were also very damaged, and the area was very damaged from the hurricane. There was a lot of rogue contractors coming down to South Florida, taking advantage of all the insurance money that was now flowing into the area. We were a victim of that too. So we not only had a damaged house, but we also had a bad builder or roofer, so we ended up having to sue them, and it was all an absolute nightmare. So what happened in the end was, as we short sold the house. And what a short sale is where you sell for lower than what your mortgage amount is, and that was in our case about $250,000 lower. If they forgive you from your debt over here, they classify that as income. They give you what's called a 1099. But Obama passed a law allowing the forgiveness of the debt to not be counted as income for all the people like us. So we did get relieved of the debt completely free without having to go bankrupt or anything like that. So it was actually it wasn't a bad experience, actually. And there was a lot of government stimulus money coming into the market. But as you've said, the market is still recovering and has only just now got back to the level that it was back in 2005. And many of my friends there are just about getting back to the property values that they bought in at, because they have stayed, of course. They didn't like I did, but it was a very traumatic time where people were getting foreclosed on constantly. And the other thing I should mention is that the courthouse in Broward County, the county we lived in, was so backed up with foreclosure cases that people were living in their houses without paying mortgage or any insurance or anything like that for years and years and years for the county to get around to actually dealing with the foreclosure case. And they have to deal with the foreclosure case in order to evict them. So there was neighborhoods full, around me of people that just were actually just not paying their mortgage, which is actually one of the major issues that the banks had. Because here in the US, you can just stop paying and they have to evict you. And if the courthouse is so backed up, they can't sell your house, while you're living in there. So it was a very interesting time to be in South Florida, actually.
And of course, one of the things in the US market is that most people have a fixed rate long-term loan, right? It's not like in Australia where most people have a variable rate loan.
Yeah.
So so how does that make the property market different from, say, Australia?
Well, it's so some people qualify for those loans you're mentioning, and some don't. Some people, the only way they can get a loan is get one of those adjustable rate mortgages on the subprime market, which is another area that blew up during the recession. But what we managed to get was a fixed 30-year interest-only mortgage. Actually, thankfully, it was an interest-only mortgage on that house because of what happened. I don't have one on any of the properties I own now, but yeah, you can get a fixed-rate interest-only mortgage for 30 years or even more at a rate, and that makes things very predictable for you as a homeowner. It doesn't matter what happens then, of course, to interest rates. You have a very predictable payment. It's excellent for investment properties too. But yeah, I don't see those types of offers being made in any other country other than the US. Canada doesn't even have that, so it seems to be exclusive.
Yeah, no, you can get perhaps a 5-year fixed here, but most people don't. Most people just are sitting on variable rates, and of course have benefited from the last couple of RBA decisions to take rates lower. So that's you win on the downside. You may not win if rates go the other way, I suppose. Yeah. But in terms of in the US property market generally, I mean, I've always been fascinated by the fact that property is less expensive relative to income in the US compared with Australia by a dramatic amount.
Yes.
And even before the global financial crisis, that was true, and it's even more true now. So property is more affordable, isn't it, really, relative to Australia?
It is, absolutely, for a couple of reasons. In the bigger cities where it's less affordable, you have a lot of regulation, like things like rent control and things like that, which hurt investors. And so there's less of that kind of investor orientated money coming into the market. If you think about the Asian investment into the United States, they're much more keen to invest in markets like Canada. Look at Vancouver, for example, and the amount of Asian investment that goes in there versus in San Francisco, because San Francisco has rent control, so it makes it very hard as a landlord to kind of, and not only do they have rent control, but they also have a lot of other regulation where you can't evict anyone and things like that. So it makes investment more difficult here. That keeps property prices to a low level. And the second thing is cheap labor. This, as I'm sure you're hearing about, Donald Trump and policies and things like that around immigration. But, here, if you see any type of development that's going on, 99% of the people doing the work are not speaking English. They're prepared to work all day. They work, 12, 14 hours a day. It's 100 degrees outside. They're working now, all the time. I live in a fairly affluent area where there's new houses going up all the time. I might do a drive around for you and show you. But the labor force is low wage here. They don't have that massive minimum wage you have in Australia, and they also don't have the lack of land that you have an issue with in the UK. Land's pretty cheap, especially in Texas where I live. So yeah, you can buy an enormous house for a low amount of money here, which is one of the reasons why we live here.
Okay. And the other thing I've noticed is that the price movements are quite variable across the country, right? So I noticed that in some areas like San Francisco and around there, they're moving in one direction, New York another direction, and other areas again. So I think people should understand that the US, just like Australia, is not a single market, is it? It's multiple markets in doing multiple things.
That's right. Here in Texas, of course, we're quite tied to the oil price, especially what's going on with shale and fracking out in East Texas. In California, of course, in Northern California, you're tied to the tech industry, and that's doing really well at the moment. And of course, in New York, you're tied to the banking industry and the financial industry, and that's doing very well as well. The less predictable markets that you're talking about are those markets that are more reliant upon things like tourism, like Florida or Las Vegas, and those are the markets that go up and down really quickly.
Yeah, and of course, Las Vegas was one of those areas around the global financial crisis which really took a bath, didn't
Absolutely. It? Yeah, they went down actually more than Florida. I knew people who were down 70% in Las Vegas.
Yeah.
So,
yeah. And looking at the trends there now, they sort of went up again and down again, up and down. So it's very unpredictable in those particular markets.
That's right. And now it's going really well over there. Actually, Las Vegas is propped up by the tech industry and having conferences. I've just 2 weeks ago I was in Las Vegas for the HPE conference, and thousands and thousands of people there, all on company expenses, spending loads of money, and everywhere is full. All the planes there were full. The airport's full. It's a booming economy there now, and I think real estate's going up at about 15 to 20%. I'm hearing. So now we're in. So would you ever be, as an intelligent buyer, would you ever be buying in Las Vegas as any investment now? No way. What you should be doing, if you have any there, is you should be selling. Same in Florida, in my opinion. I think it's all about timing. I have a global property portfolio, and that enables you to look at all these different markets and understand, what kind of causes them to go up and causes them to go down, and also look at the currencies. The currency in the UK is quite depressed at the moment, as is the housing market, because of the Brexit situation, and everybody's a bit unsure about that. But I think it's a very good time to invest in the UK because of the depressed currency and the depressed housing market. That's what I'm doing at the moment, actually, because I think it's going to come back, and quite significantly. On Australia, I think it's a very expensive market to invest in. Here in the US, I wouldn't be investing at the moment because it's very high. I think there's a correction coming in the US because, I know personally, and most of the people in my industry, which is quite a well-paid industry, I'm in the tech industry, and we're not earning any more money than we were 10 years ago, and most others aren't. And yet, 10 years ago or thereabouts is when we had our massive recession. So, I think something significant's coming. Also, the stock market's hitting all-time highs, and there's all these trade wars going on. Who knows where that's going to go? But I think, after the election, we have a big election next year. I'm sure you heard about that. Once that's done, I think we'll be back to reality again, and that might not be so positive, particularly for the US dollar or the housing market.
Well, certainly. I mean, some of the investment bankers are forecasting a recession over the next 12 to 18 months, 40, 50, 60% probability. So if that were to play out in the US, then a lot of those chickens would potentially come home to roost, although, of course, the Fed will cut rates again and again, right? So, and they do have some capacity because they put the rates up previously. So.
That's exactly right. Yeah, I think, yeah.
So you've also got property in Australia, and we were talking the other day about the investment property you got here and the interest-only loan problem that you're now facing. I wouldn't mind just talking about that for a moment or two. So, what's the story there with the interest-only loan?
I'll tell you what happened. So, in the couple of years I was back in Australia, we have done over the years really well with real estate, and particularly the house that we have up in Brisbane in Spring Hill. It's very close to the city, and we did extremely well there. Just in a number of years. At it, and how easy it's been to rent out as well. Excellent investment. But while I was there, I was looking at potentially buying another. I have other investment properties in North Queensland, but buying another investment property in Sydney, and it just seemed so ridiculous at the time when I was going to, I won't say who the bank was, but they just seemed to want to lend money, and I'm not talking about small amounts of money. I'm talking about millions and millions of dollars. And I'm working for a US company at the time, so foreign income. They didn't care about expenses or anything like that, and it was just they were just willing to hand over a chunk of money. I don't know what the person I was sat in front of was getting a big commission out of it, but anyway, I did take him up on that a few years ago. Around 2016, I bought an apartment in Sydney, around $1 million. And I completely borrowed all the money. It didn't cost me a damn thing. Equity properties I've got over there, and was the 20% required. And I got a 3-year interest-only mortgage, and at a pretty low rate too, around about 3% actually. So I definitely took them up on this. And the investment property is a unit. It's in the city in Sydney. It doesn't have a view of the Harbour Bridge or anything, but it's in a great location as far as near all the Hyde Park and all that. So, and it had tenants in it when I bought it actually. So it's been an excellent, and the same tenants are in there. And the management company is great. That's key, by the way, when you have investment properties, get a good management company so they keep it full and keep it maintained. So my interest-only mortgage for nearly $1 million is coming to reset in November to become a principal and interest mortgage. And I think what you're seeing evidence of, given the panic reduction in interest rates in Australia, is completely caused by issues like mine. Now, I'm in a luxurious position of being able to deal with this change very easily, but I'm sure that there are many over there that are not, or certainly wouldn't have been had the interest rates not been so dramatically reduced. And so, I'm just seeing a personal situation and then a significant reaction from the Australian Reserve Bank. And I'm correlating the two, and I'm just assuming they're related. And I think they are. I think there's loads and loads of people like me that bought in quite high, and are now, the banks are thinking, are we going to be able to continue to pay the loan once it resets?
Yeah, well, it's interesting because there's about 120 billion per year over the next 2 or 3 years going to reset, right, of interest-only loans in Australia, and our survey suggested about 1/3 of them will be able to be switched to another interest-only loan, no problem. About 1/3 will move to principal and interest.
Yes.
With perhaps a 35 or 40% increase in the cost of the mortgage repayments because of it, and about 1/3 look to me to be very marginal, even with the changes that have now come through. Right. So there are people who are really going to struggle with knowing what to do with their investment property. But the other side of it, of course, is that rentals in many areas in Sydney are actually now dropping. Now, if you've got a really good unit in a really good place, probably not an issue. But for many people who've got units in probably sort of second level or worse locations, the rentals they're now getting are lower than they were previously. So suddenly the economics begins not to work. And as you say, the get out of jail card may well be the interest rate cuts. And I do think you're right that it's been one of the main reasons why people, have seen the Reserve Bank cut rates, because I know that they were concerned about the level of risk in the system.
Right.
And of course, lowering interest rates can. And of course, the other way around it is that they said some time back that it was hard for them to lift rates because of the fact that people were actually going to be under difficulty if they did. So it's all part of that same story. And the debt mountain here in Australia continues to build, and all the strategies announced over the last few days is just building the debt bomb even bigger for later. So it's quite interesting, and now people are saying, well, maybe property prices are going to recover, and maybe people will actually be able to muddle through a bit longer. But of course, the question is whether many people will actually still end up with egg over their face down the track, and that's the unknown quantity, I guess.
That's right. Well, the other thing that's been concerning me recently, of course, is all this chaos with Opal Tower and Mascot Towers, and I had no information when I purchased this quite expensive unit as to the structure of the building, and I really didn't take into account any of that. You assume as a buyer that everything's fine. It's been there for a while. It's a bit of a boutique building where my apartment is, and I think that's a good thing, because it's actually one of the smaller buildings, and it's surrounded by enormous skyscrapers. So you think that it is relatively structurally sound, given and it's on very solid ground, given that it's not the biggest building by any stretch of all the buildings in the area. But as a buyer of an investment property, you just take it for granted that it's just going to be structurally sound. Another investment property, actually one of the first ones I bought in London in Old Street, is an ex-local authority building. Can you imagine what I thought when I saw Grenfell Tower? My first call was to my agent. Do we have any of that flammable cladding on the building? The building I have. I'm in a building called Godfrey House, just off the Old Street roundabout there, and it's and thankfully it doesn't, and the only reason why it doesn't have that cladding on it is because the building where my apartment is has balconies. They were less keen to put that cladding on buildings because it's much more complicated to do when there's balconies. So there's a tip: if you're going to buy in a local authority, buy in a building that has balconies, because it's less easy to put that cladding on. But again, I think it's really important. I've been very blasé, and I won't be anymore, I'll tell you that, about buying apartments and what to look for, because I've touched wood, I've been a bit lucky so far, but I'm sure that lots of people bought them the same as I did, not even thinking, and now they're in a much more difficult situation.
Well, that's interesting. And of course, in Australia, we know that there are many thousands of properties with flammable cladding on them, but those lists of properties have not been published. They have not been released. So there's a big secret about it at the moment, and people are trying to find out more information about whether there are particular properties with issues, because of course the flammable cladding was used in a lot of buildings, and of course a lot of the imported materials were perhaps low quality as well, and that takes you back into the broader issues of poor quality construction. So my theory has been that modern units and apartments, from perhaps the last 5, 6, 8 years or so, and those being built today, that will put a significant dampener on that sector of the market ahead, despite the fact we've got stimulus and low interest rates and things going on at the moment. So I think there's probably more mileage there as to the issues that will arise, but who knows? It's an unknown quantity. So as we come to the end of our conversation, one last question for you. What would you say to your current self, if you were going through this process now, so a message to your younger self from your older self, right, with regard to property investing, and what have you learned, and what would you do differently?
Well, don't buy Florida in 2005. That would be the first thing I would say. I would say, to my younger self in the mid-90s, when I arrived in Sydney, I should have bought as much property as I possibly could have done, in Manly where I was living, or Bondi, or any of those iconic areas, because, even though you've got a challenge, kind of a challenge at the moment, I think generally it would have been one of the best investments you could make. especially if you're spending British pounds, which I think at the time was about 3 to 1 back then in the mid 90s. So not only
Yep.
just by doing that and then benefiting from the gain and refinancing and putting that money back in England, you could buy yourself a beautiful house in in London with what you've made in just by sitting on property in Sydney. So and with the currency conversion. Be careful when you're buying apartments, like I just said, with just make sure that, if you're buying apartments in these big cities that, the building's been around for a long time. It doesn't have this challenge with it. In South Florida, another thing that was really causing the building industry a challenge was what was called Chinese drywall. I don't know if you ever heard about that, but I went into a house that was being sold on the cheap that had all this Chinese drywall in it. And even the stainless steel counters were going rusty. It was causing that much corrosion. There was some gas that it was giving off that was corroding everything, including stainless steel taps and stuff like that. Unbelievable. So, and the smell was, really, really bad. So, so be careful of cheap building materials, of course. I think my younger self, of course, was able to get financing on with structures that were very different today. I bought houses in London that I was able to get tracker rate mortgages on and things like that. Tracker rate mortgage, interest only. I've got 2 properties on a tracker rate mortgage at the moment, which is 0.5% interest only. Unbelievable. And it's been like that for years. Literally half of the rent of one of the properties pays the interest-only mortgage for both of the properties. Unbelievable. So I should have taken more advantage of those offers when they were around, because you can't get them anymore. But I think if you're in your early 20s, you should get on the property ladder as quickly as possible. That would be my advice. Now, be careful now, of course, but I still think there's certain areas where you can do well. Personally, I'm looking at properties now in Heathrow Airport. It's a very good area around just west of London. They're going to destroy 2 villages when they build the 3rd runway, and the 3rd runway will create 10 years worth of employment around Heathrow Airport, and you're going to have a shortage of housing because they've got to destroy 2 villages in the process. So the great property investor is all about making sure there's a demand, right? And a constant and hopefully growing a flow of people prepared to rent those properties that are in demand. I would say another area in Australia would be Cottesloe, or somewhere very nice in Western Australia. I used to go over there a lot on business, and I knew people who lived in Cottesloe, and it's beautiful. And not just that area specifically, but areas like that. So if I was going into the property market now, in Perth, where it's 20% down from the peak, probably more than that in other areas. But get in good areas, like blue chip areas, because I know that the top end of the market, the very expensive houses, are falling the most there in Australia. I've seen that on your program, actually, Martin. But I think if you buy the cheapest house in the best street, I think that's a very good strategy. So if you get into a fixer upper in Bondi, beautiful, would be a very good investment.
And it's very interesting because Chris Bates, one of our other guests, who's a financial planner and mortgage broker and advisor, says exactly the same thing, right? Be very careful where you buy, and go for the best locations, because it's actually the locations fundamentally which will win out, rather than just the deal that happens to be in a second class or worse level location, because a lot of those in a downturn will lose value more quickly, where there's always going to be demand in the really good areas. And I think that's proved to be quite good advice. So.
Yeah, and also have properties that you can add value to. So if you buy an apartment, it's very difficult to add any value to it, like renovate it, extend it, things like that. But if you buy a really old, run-down house in a really excellent place, then even if the market's going down, even in that area, because you're able to use your own time to invest in doing the property up, you're adding value into the property anyway with your own time. So you can still salvage your investment by doing that in a worse situation. And the other thing I would do is is invest in low-end properties. You would tend to find that the low end of the market is the area that's being stimulated by government. If you think about, first-time buyer programs, stamp duty-free to a certain amount, that's always been the case in Australia and has in the UK too. They've never done that. They don't do that here in the US because the property market is pretty inexpensive anyway, and we don't have stamp duty in America, so you don't have that big hurdle. But if you also invest in that part of the market where the government is doing a lot of stimulation, then I think you'll be okay as well. And that's a much easier part of the market to invest in too, because it's lower priced, right? So it's easier to get financing.
Yeah, very interesting. Well, Anthony, look, I appreciate your time today, and thank you very much for spending it with us. What I'd like to do is to check back with you down the track a bit and talk further about the US market, and perhaps I'll do a bit of research as well, and we can get into a bit more detail with some of the dynamics over there, because I've had quite a few requests on the DFA channel for us to extend our coverage into places like the US and Europe and what have you. So it's an opportune time to have those conversations, and so let's chat again down the track.
Look forward to it. Thank you for your time, Martin. I appreciate it.
Thank you very much, and great to talk to you.
Likewise.
See you later. Cheers.
Bye.
Bye.